This line chart shows how common later life separations have become. A divorce that happens at age 50 or beyond is known as a gray divorce, and the rate for adults 65 and older has tripled since 1990. Splitting up after decades of marriage presents unique financial challenges. You aren't starting fresh. You have to divide a lifetime's worth of accumulated wealth, untangling homes, retirement accounts, and complex investments. Amid all that division, one specific asset routinely gets misclassified or entirely overlooked: the existing life insurance policy. Decades of premium payments have transformed that policy into a liquid financial asset, often worth significantly more than its cash surrender value at the time of separation. This creates a direct conflict. Most divorcing couples want to completely sever financial ties, but walking away from a policy you funded for 20 or 30 years means walking away from a major piece of your net worth. You have three distinct strategic paths for that coverage. You can keep the existing policy, you can replace it, or sell it on the market. Treating the policy as a hard, appraisable asset rather than a monthly bill ensures that neither spouse accidentally leaves a massive cash payout on the table during settlement negotiations. The first step in valuing your policy is looking at your ongoing legal obligations. This flowchart maps the first decision point. If the divorce settlement requires one spouse to provide ongoing income protection to secure alimony or a pension sharing agreement, the coverage is essential. The path points directly to keeping the policy. Choosing this path requires the settlement to define exactly who owns the policy and who is responsible for the premiums. Your financial ties will remain intact for as long as that support is required. For couples who want a clean break, the second step is a medical reality check. Is the insured spouse still insurable? Replacing a joint policy with separate individual ones becomes difficult if one spouse is significantly older or in declining health. If the insured is now uninsurable, that active policy is an irreplaceable asset. In a gray divorce, that existing coverage might be the only life insurance you can ever realistically hold. If both spouses are still in excellent health, you have the flexibility to drop a joint policy and buy separate new coverage to achieve total financial independence. Your medical status and your legal support requirements dictate whether an existing policy is a dispensable burden or a safety net that you must protect. Often, the economic need for the coverage is gone. Neither spouse wants to maintain the policy or keep paying the premiums. In this case, the natural instinct is to stop writing the check and let the policy lapse to save money immediately. While lapsing eliminates the monthly cost, it provides zero financial return. You walk away with nothing, abandoning an asset you've built over years. The insurance company's default alternative is surrendering the policy for its cash value. Surrendering provides a fast, guaranteed payout, but that cash value is usually a small fraction of what the policy is worth on the open market. This bar chart comparing average payouts shows why the secondary market is so lucrative. In 2022, life settlements generated 5 times more than the cash surrender value on average. A life settlement involves selling your policy to institutional buyers for a lump sum. The payout is greater than the cash surrender value, but less than the total death benefit. This process involves a medical review of the insured and a longer timeline to finalize the sale than a simple surrender. By capturing that market value, you transform an expensive liability into a 6-figure lump sum that changes the trajectory of your settlement negotiations. Every material change to a policy, whether it's a lapse, a surrender, or a change in beneficiaries, should be preceded by a formal valuation. This matrix maps the correct legal action based on ongoing financial support and the insured's health. Top left, high support needs and declining health. Keep it. Top right, high support need but excellent health. Replace coverage. Bottom left, no economic need and declining health. Sell as a life settlement. If your matrix outcome points towards selling, how you execute that transaction determines your final payout. Many direct buyers who advertise on television are incentivized to purchase your policy for the lowest amount possible. To secure the best offer, you must work with an independent sell-side advisory firm. They act as a fiduciary, meaning they are legally obligated to represent the policy owner's interests. A fiduciary firm manages a competitive auction among institutional buyers, forcing them to bid against each other to drive the cash offer to its highest possible point. By matching your health and financial realities to the correct strategy, you can fund your independent life using a valuable asset that many people simply throw away.